All right. What is going on, everybody? It is Wednesday, October 5th. The days go by fast when you're working hard, but episode 32 of Market Talk today is a very, very, very special episode. I'm so excited to be here for you all with our very special guest who I'll introduce shortly. I will say now that we are joined by the one and only, the infamous and legendary, notorious Hodl Magoo. We will introduce him here shortly. Some of you guys might be noticing, listen, first day with a new microphone and a webcam. So listen, we're taking things seriously here. You know, you get your content up and you level up from an iPad to a $40 microphone from Amazon. So as Drake says, there's levels to this. And so pretty excited to be here. You know, guys, we're doing our best to just, increase the content quality at all times. So, we got this set up. We take this very seriously, what we do it because Bitcoin and running Market Talk every day, Monday to Friday at 4:15 Eastern. So listen, guys, if you're here for the first time, if you're here from Magoo's channel, we talk Bitcoin, talk equities, talk about everything. Consider Magoo a friend of mine, have known him for some, 6-8 months now or so. And he was kind enough to join us today. He is an incredibly busy man, working hard to advance the Bitcoin space and, integrate his knowledge into traditional financial instruments to expand the Bitcoin community. So I'm going to introduce him here shortly. I do want to say this as an aside. So, as I said, obviously we've got Magoo on today. We're going to talk macro. We're going to talk Bitcoin. Magoo, by nature of his intellect and what he provides, I told him before, I want him to be, out of all the words spoken in today's episode, I want 80 to 90% of them to be from Magoo. But I do want to provide a very brief update to you all who tune in daily. As in regards to my positioning in the market, I became extremely bearish today. I've allocated about 60% of my capital to some longer dated short positioning that I won't get into, for sake of time because Magoo's time is limited. But I have started shorting. I'm short the NASDAQ pretty aggressively. I've built some really small shorts on Ethereum. I think it probably can push higher, maybe. I'm not so sure about the equity market. I saw bonds, oil, and the dollar calling bullshit on the upside move in the equity markets today. I know some people here trade, some don't. A lot of you guys like to keep up with my options trades. Just want to let you know, I got super, super bearish today, and, I wish I could really unpack it, and maybe I will be able to. But again, we've got things more important than that right now, and that's our guest, Hodl Magoo, the one and only. And so I just want to take this time to introduce him. And for those of you who don't know, I gave a brief descriptor. I think, what he has to say will speak for itself in terms of his intellect, his understanding of macro, Bitcoin, traditional equities. So so excited, so thankful to have him on today. Magoo, thank you for being here, man. And I just want to take a step back now and just give you the chance to take it away and talk about what you're feeling in regards to, whatever you'd like to discuss. So floor's yours, man.
Yeah, no, thanks. It's great for having me. It's great to be here. Always like shooting the shit and talking macro and Bitcoin with you guys. So definitely this pleasure is all mine. Um, I don't have too much of an agenda because I'm not a very agenda oriented person in what I want to talk about here. I'm not here to shill a book or my book or anything. We can kind of go with the flow and see where it goes. I guess we can start off with at least just what my opinions are on the market right now, or at least the psyche. I'll call it the psyche of the market because we had this incredible bear market rally that I'll call it from basically June, bouncing from around 3,600 on the S&P all the way up to, I think we got up to 4,300 or something. And then that's where you started seeing people call for, end of the year S&P 5,000, end of the year S&P like all-time highs, yada, yada, yada. The list goes on, like market melts up, yada, 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 right? And then everyone's hopes were just dashed, right? When it's like some of the quickest market declines, I guess, in the broader index called the S&P, of just tanking from the 3,300 area all the way down to new lows. I think, if I'm not mistaken, I think we got somewhere down in the 3,500 area, and kind of clawed some of that back now over the last couple of days. But this is to me a typical bear market, right? Like you have on average, the market goes down a little bit every day. And then when there's perceived good news or good news, the market reacts in a big way to the upside, right? And it's the reverse opposite when you're in a bull market, right? Where on most days it goes up. But then when there's bad news or perceived bad news, it tanks a lot, right? And that's exactly what we're seeing. And really, like I'll just shout out Mark Yusko. He's the one who kind of like articulated what I just said, right? Which is spot on, right? And this is what we're seeing now, indicative of a bear market, right? Like it gradually it goes down ever so slightly each day. Most days it's a red, and then on perceived good days or perceived good news or good actual good news, the market reacts in a very positive manner, right? Like there's no in a bull market, the S&P index doesn't go up 3% a day. Like that just doesn't happen. That
Right.
happens in bear markets, right? Like that's a bear market rally, right? When you have these sudden jumps up, right? So I still think we are in a bear market. There's some people out there that haven't even capitulated to the fact that we are in a bear market, right? Because there's people in at least traditional finance who says, okay, bear market is anything down 20%, right? And we're just starting to cross those thresholds now on broad indices. I think the S&P is around 25% down. And so they're still holding on to the fact that there's going to be like a Q4 rally and that we're going to finish the year only maybe 5 or 10% off of the peaks in 2022. When I think in reality that's just kind of naive. A lot of these quote unquote, I won't even call them macro analysts because most of these people that you see on TV, the talking heads and the bullish people, they're more market analysts. They're not macroeconomists, right? And they are using back tested models to basically say, well, this happened in the past, well, where basically the Fed has hiked and broad indices have went up, or during QT potentially in the past, markets have gone up, right? And they can't think past, like they can't think their way out of a wet paper bag to realize where we're at in the debt cycle and how much debt is been loaded onto the system across not only private but federal and everywhere, every way, corporate, individual level. There's just so much debt, and as these interest rates are rising, it is putting tremendous stress on the markets in general. Like, and just to zoom in on one particular area where these rates are really affecting the individual is mortgage rates, right? You have 3 years ago, the average house price or single family house in the United States, I think was roughly $400,000, and the interest rates were what 2 to 3% on your fixed mortgages, and now your average house price is up and closer to like the 700,000s, and the interest rates now for mortgages, I think at one point I think they peaked to 7%. I think they're in the 6% range now. Just that monthly differential on the mortgage payment is astronomical to most individuals, right? Where they might not be able to even afford that, right? And so it puts us into a precarious situation like 2007, 2008. Not so much because variable rates are not as predominant as they once were, which is a good thing, but there's still going to be a lot of people out there that are not going to refinance. They're not going to take equity out of their house to have cash to spend because the rates are too high. There's people that are not going to buy because rates are too high. And so that's just one area where it's just really going to put the brakes on the economy, right? And that's just real estate. Like we can talk about a whole slew of different markets, but that's just real estate that's really going to put the brakes on the economy, right? And that's what the Fed wants, right? Like this is what I don't understand. These same people that are bullish today, and I'm not a perma bear, right? Like I'm just bearish right now. I'm not always bearish because obviously I have my long-term projection of where Bitcoin's going. But the people that are bullish today essentially said during the run up of 2020, when the Fed was just printing more money than you could possibly imagine, and we had ZERP, they were saying, don't fight the Fed. Oh, okay. Okay. Don't fight the Fed. But now the Fed is telling you the exact opposite. But now they're telling you to fight the Fed,
No,
right?
but
Like so.
didn't you know that rate hikes are actually bullish for risk assets if that wasn't appropriately evinced by the Nasdaq right now? Didn't you know that?
Yeah,
didn't
exactly.
Magoo? What do you mean you haven't been longing bonds the entire 40% down move this year?
Oh,
What's
and
wrong with
that's
you, man?
that's the best part. Like if we want to get into those traders, like, or I don't even want to call them traders, but like there's people that have been like the quote unquote macro economists of, let's call it Bitcoin Twitter, have been calling for to basically to be in long bonds, right? And they've just got eviscerated like so badly. And like I was saying, since I think it was the beginning of 2021, I was like, being long sovereign debt here is not the play. Like we are almost at zero interest rates. Like when I was tweeting that out, not quite. I think we were at like Fed funds was like 25 bips or maybe 50 bips. I don't remember. And I said, like, this is not a safe haven asset in this environment, because like if they do start to raise rates, and they did it very aggressively, those bonds are, you're going to get, like, let's forget bonds, just call it TLT for now. Like TLT is going to get absolutely wiped out. And they did, right? And then they tried to time the peak, and they timed it wrong, and then another peak happened, and another one, and then I think now we're probably going to have another one. And because everyone's now saying, oh, rates have peaked, because they haven't been listening to the Fed, right? Each tenure of like the chair of the Fed, whether it's Powell, Bernanke, or Greenspan, or Volcker, or whoever throughout history, they all have a different style of managing. And the only thing that I can say for Powell in a positive sense is that for more or less, he's done exactly what he said. Where Greenspan and Bernanke, they were very good at obfuscating what they were going to do, and they were kind of confusing the market. Where Powell has been very forward, not only since the beginning of COVID, but all the way up to now, about what they want to do. And you have all the FOMC members as well voicing over the last couple of days that they are going to be holding tight to their rate hiking, right? Announced to the UN, who's crying to the Federal Reserve to stop the rate hiking cycle. Why the UN is doing that? They are not a financial institution or organizational at all. But people are still in denial that the Fed is going to go through with what their dot plot says, right? And they're sniffing a pivot, when in reality they're really just sniffing their own farts, in my opinion. So like it's very hard for me to look at this logically and try to bet against the Fed at this point. Like if the Fed is saying they're going to get inflation under control, and even if you have month over month inflation at 0% for the next 4 or 5 months, inflation year over year is still like going to be between 4 and 6%, right? Like people don't understand math, right? And so inflation is still going to be high going into Q1 of 2023, and they need to get inflation down. That's what they said they're going to do, and it's what they're going to do.
Magoo, one of the things I want to ask you is one thing that I found both one thing that I marvel at and also find perplexing and confounding, in fact, is that people this entire way down have come out and just adamantly, promulgated that inflation has peaked since like April. And each month we see new metrics indicating the exact opposite. Like if I could tell you the amount of times I've seen, look, I've put a ton of time to trying to learn macro to be able to at least hold my own in conversations like this. I'm certainly no expert, and I don't claim to be. But to me, it was always pretty clear that inflation, in fact, hasn't peaked. And it's been so interesting to me to see a lot of these sort of self-appointed macro experts who speak on specifics with, a lot of confidence about inflation's peaked. Inflation's peaked. This right here is a definitive illustration that inflation has peaked. And of course, we've seen that that's not the case. And so I'm wondering how people can say that, given that the bond market, the dollar, and commodities, namely oil, are all telling you inflation hasn't peaked. The bond market, more than anything, we've had a 200 plus point rally on the S&P in 2 sessions, right? Broke over 3,800 today. you've seen a monster move over these last 2 or 3 sessions, and bonds are like 1 or 2% off their year-to-date lows. They haven't even moved during this rally. This is in conjunction with OPEC announcing a substantive oil output reduction. We've emptied the SPR to bring gas prices down. We've seen the last couple of weeks. I mean, I know you're not in the United States, but gas prices have come up meaningfully over the last couple of weeks, pushing $4 a gallon here where I live in Kentucky. A month ago they were 320, 330. So why do you think it is that there are people who are willing to live in such blatant defiance to the monetary policy regime that's at play here, where, you have yields are probably going to go to new highs? We're almost certain to see new lows on equities, in my opinion. But why do you think it is that people are so emphatic about, buying companies that are still historically bloated, people who are calling for a melt up, people who are just anticipating like a QAnon supporter, like just any day now, Jerome Powell's going to come out and announce we're returning to ZERP and we're going to print money again with 8% inflation that's going to remain sticky through, at least the winter, as you've already indicated. So what's going on here? Like, why are people so intent on just lighting their money on fire? I don't understand it.
So I think it's a couple things. One, I think it's mass psychosis, because they're still in denial about how bad the markets have done in the last 6 months, right? Like, you have people where the whole idea of the traditional 60-40 portfolio is, well, if equities go down, I'm going to make it back on my bonds. And if bonds go down, I'm going to make it back on my equities, and vice versa to the end of time. But this is one of the very first times, at least in the last 40 years, where we've been in a macro environment where bonds and equities have gotten smoked, right? So you have to remember, there's a lot of people out there that have just got absolutely smoked. And a lot of these talking heads, whether they're on cable TV, whether they're on Twitter, TradeFi Twitter, or whatever they are, most of these people have a very skewed incentive structure where they're probably asset managers, money managers, financial advisors. They have some stick in basically net long positions, right? Because when it comes to it, a lot of the people that are on Wall Street, most of their funds, most of everything is net long, right? Everything's built off of net long. It's not until you get into hedge funds and very, very exotic products where they're actually into hedging, they're actually into shorting the market. And so I think there is a very big vested interest in a lot of these people that are talking, the so-called experts, that they want the Fed to pivot because their strategies or their thesis does not work in this environment, right? And so I tweeted this out I think 4 or 5 months ago. I said, it's not going to be too long until you see some really wealthy people start crying that the Fed is making a policy mistake, right? You can see let's take the perfect example, a Cathie Wood, right? Where her entire, I don't want to call it her entire thesis, but her entire like portfolio construction with her ETFs and her funds are on basically benefiting from ZERP, right? Because all of her holdings are high growth, high innovation stocks, which perform way better when interest rates are low, right? It lets those PEs get right out there. Right. And so, of course, her saying that the Fed is making a policy mistake, can you actually trust her? Or is she just talking her own book? Right. And I think a lot of these people out there are realistically just talking their own book. Right. So I think that's part of the problem. And that's always part of the problem in finance is everyone's always selling their book. Right. Anyone that has an opinion that's probably worth listening to is probably in the industry, and they have a skewed incentive structure to give you one side of it and not the other. Now, why do some people are just so adamantly wanting to be bullish and stay long here? Well, there's this adage that longs or bulls make money no matter what over the long haul, right? You could be a plain old idiot and put money in the S&P over the last 20 years and not do anything, and you pretty much outperformed all the hedge funds, right? And that they think that, well, all I got to do is put money in, time in the market rather than timing the market, right? But they just fundamentally misunderstand that a lot of the money of these big guys like Druckenmiller, Ray Dalio, all these big guys, they're making in like the Oppenheimers, like they're making their money by preserving capital in these bear markets, right? They're not out there trying to risk their shirt making money in bear markets. They're out there taking risk off the table and preserving capital that they can deploy when they think is a good time to deploy it, not at historical high PEs and historical valuations while we're in the fastest and most aggressive Fed tightening cycle ever in terms of percentages, right? So I think you can take your pick at one of those things I just said, and most people will probably fall into one of those buckets on why they continue to want to just light their money on fire. But here we are.
So let me ask you pointedly, how do you see the next 6 months playing out in terms of inflation, macro, asset prices? And then from that, give me an explanation on how you see Bitcoin bottoming, unless you think it already has bottomed, and how it performs in 2023 and on.
So I think the lows are not in. And I guess if I had to sum up my thesis, it would be I predict that the Fed is going to still.
I'm not sure if this is just me, but Magoo, I think we may have lost your audio. Max, I don't know.
Did you hear me?
Is it just me or?
I can hear Magoo just fine. Can you guys?
I think Carter just cut out there. I think he froze for me. So I think
we're still live on YouTube, so we should be good here. Let's okay, so he left. He'll rejoin here.
I can
yeah. Are we good?
Yeah, we're good.
Okay.
Right, we're back in a big way. Let's do it.
Yeah, so let me just kind of start where I left off with where I see us going in the next six months. I guess if I could sum this up in about a sentence, it would be I foresee the Fed continuing to play everyone like a fiddle. And what I mean by that is I still believe that one of the Fed's biggest monetary tools is psychology, and they're playing people to a T when it comes to the psyche of the market, where the market goes down a lot. And if it doesn't go down enough, they're really out there voicing their opinions to control the market where they want to go it. So I think they're going to continue to kind of play everyone and have that slow grind down. There is a chance that there is going to be a breaking point. Like when there is that breaking point, when they finally do pivot, that capitulation, there will be a lot of volatility probably to the downside. But until that moment, I think it's just going to be a lot of up and down, slowly grinding lower until they finally pivot after something finally does break. I don't think, like, this is another thing. People have different definitions of what a pivot looks like. Some people say a pivot's not until they actually start cutting rates. And other people say a pivot is when they stop raising, right? I'm more of the belief that I don't really call it a pivot until they start cutting rates, because, like, let's say they only make it to 425 basis points on the Fed funds. Okay, that's cool. And they stop, and December is the very last hiking. And everyone's like, oh my God, the Fed's pivoting. And then let's say they hold Fed funds at 425 basis points until the end of 2023, right? Like, to me, that's not bullish. That's extremely bearish. So I don't consider that a pivot at all. So where I see that happening is they'll get relatively close to where their dot plot is putting them to. Maybe November and December are the last hiking. Whether they do 50s or 75s, they could get up to around 425 basis points potentially. If they do another hike in 2023, that's uncertain at this point. I don't think it matters so much at this point. I think the thing that matters the most is how long they hold it there before they start cutting. Because even if they say December was the last hike and they just held it there until, let's say, June of 2023, you have roughly 6 months of things to go relatively bad, right? Because it takes a while for these interest rates to kind of cycle through the economy, whether it's through the real estate markets, whether it's the corporate markets, the bond issuances, all of those things. It's going to take a little bit of while. So it's going to allow there to be time for things to really start breaking, right? We've already seen things break in the UK. I'm more of the belief that when things start to break, it's probably not going to be so much inside the United States. It's going to be external, probably other sovereigns. Like you see Credit Suisse having issues. You've seen the UK pensions having troubles. And tomorrow it's going to be some other country. And then the next day it's going to be some other country. So I relatively believe we haven't seen the lows. And now that's for indices and Bitcoin. I think Bitcoin and crypto in general will probably bottom first. How much first is the real question. But I think risk assets will bottom before everything else does. Kind of like typically when you're in a slowdown, you'll see risk assets bottom first, then you'll see unemployment peak and housing, the housing hit the bottom of where it's going to hit. So I think traditionally you usually see unemployment peak about I think it's 6 months after a recession really starts. So we'll see how unemployment looks, right? Because unemployment's another kind of bullet in the chamber that the Fed really realistically has, right? Because they can keep on raising until unemployment's not basically at historic all-time lows. So I guess realistically 6 months, the next 6 months, I suspect us to be lower. You could see it that risk assets like Bitcoin actually bottom in December or January. They could bottom then, but then the equities could probably bottom in February or March, and real estate could bottom probably in June or July. But I think we are heading into an actual recession. Like here's another changing the definition on everyone of what a recession is. We are in a technical recession, but I think we're really going to start to see in Q3 and Q4 earnings to come in a lot weaker than expected. We're already starting to see signs of that with Nike and their inventory going up. It's
and
basically
FedEx and FedEx.
Yeah, FedEx as well. FedEx's CEO actually came out and said he thinks we're going into a global recession, right? And he's got some pretty good data when it comes to the real economy around the world. Probably one of the best companies that has the data to look at that type of stuff. So I do think we're going into a global recession. There's no 1994 soft landing. The Fed isn't pulling this off into a soft landing. And you have Powell out there saying there's going to be some pain, right? Like when have you ever heard a Fed chair say that there's going to be pain, right? Like is he really trying to play the market and really get to try to dampen the demand here just by saying there's going to be pain? I think that would be pretty irresponsible, but who knows? The Fed is irresponsible by its very own nature. But him saying that there's going to be pain, that should perk your ears up, because I think that's the first time a Fed chair has ever actually used the word pain when it comes to not only markets but American families. He was talking about American families are going to feel some pain. So I don't think this is a time to be bullish. Like if you want to get pretty here and get cute and make some money on some swing trades, okay, that's one thing. But being just like bullish just to be contrarian, right? I think is a dumb move.
I have one quick question about something you just said. You think that crypto has the potential to bottom before equities? Why is that?
So it's basically a liquidity thing, right? When we get into these broken states, I'll call them, right? When the Fed is tightening, the thing that it affects the most is liquidity, right? And the things that are most liquidity driven are risk assets historically, and Bitcoin specifically being pretty far out on the risk curve. It is very, very sensitive to liquidity. And when you're sucking liquidity faster out of the system than ever before, you're going to see risk assets basically be affected the fastest, right? And I think that's why they're going to bottom first. And it might not bottom and then just like it's not going to rebound, right? It's going to bottom and it could just stay there. It could flatline for a while equities go there doing their thing, right? Because remember, let's just take the Terra stuff. That whole fiasco, that was crypto front running the equity markets to some degree, right? And then a couple or 3 or 4 weeks later, or not even 4 weeks, like 3 weeks later, equities kind of really started tanking along that, and Bitcoin was just chilling. Right? Like it was just like once it capitulated to, I think 17.5 or wherever it got to, it got back up to 2,400, but equities continued to go down. So I think we could probably see that again, is where you're going to see I don't want to call it a final capitulation in Bitcoin. Like, it's not just going to trade at 19 and then go to 12. Like, it's probably going to chop down a lot lower. And then you're going to see a capitulation wick when something actually finally does break. But I think Bitcoin is probably going to bottom before, let's just call it the S&P.
Now, I've seen some people making this argument, and full disclosure, I don't subscribe to it, but sort of what you just laid out for us, which is, equities are going to do their thing and continue to stair step down. And, Bitcoin's going to more or less just sort of range and not have much of a regard for what TradFi markets are doing. I've seen some people make the argument that that's actually what we're seeing right now with, NASDAQ and SPX making new local lows, while Bitcoin failed to breach its 17.5K June low. Do you think there's any chance that the bottom is in, or we do have another level?
I don't think that we've seen the low, just because my macro view paints a pretty dark picture, at least for the next 6 months, if not the next 9 months. And a Bitcoin holding at that 19K support for even like 3 months is just very unrealistic, right? Unless we get some major breakout here, and it just continues to grind at the 2017 all-time highs, like 19,000, 19,500, 20,000. If you knock on that support door long enough, it's going to open up, right? And the problem with Bitcoin and where we're at, this is technicals, right? Where we're at with Bitcoin, if that 2017 all-time high doesn't hold on the technicals, your next support realistically isn't until 12K, right? That's your only next support on the technical level. And so there's a huge gap there where it could gap down in a big way when it finally breaches, right? Like, Bitcoin's been just doing its own thing and just chilling out compared to equities. But like, if there's like a massive risk off day in the markets where something finally breaks and Bitcoin breaks that psychological barrier and that technical barrier, watch out below, because this would be the first time that Bitcoin basically broke the previous cycle's all-time high and confirmed below it, right? Like, we obviously wicked down with that Luna situation down in June to 17, but it quickly rebounded back to that 20K area, and it's just been grinding there since basically the end of June, right? And it hasn't really done, I don't think it's done a weekly confirm below that. But if we can actually get below that, it's not only a huge technical level, but a psychological level as well, that you're now into the situation where people that bought in 2017 could be underwater, and you just create a whole bunch more sellers of people like, I have no idea what's going on here. I need to sell at a profit. I bought at 12K in 2017. I need to take a profit here, or wherever you bought in at that cycle, right? Mind you, there's still going to be the Bitcoin hodlers that are just going to be badass and just going to be buying the dips as much as they can, right? Because their time preference is extremely low, right? Because I still have a bull thesis for Bitcoin over the next 10 years. It's just that for the next four to 6 months here, it doesn't look good for risk assets, right? And not saying that Bitcoin is quote unquote a risk asset, but it most certainly trades like one today, right? That won't be the case forever. The question is, when is that precipice moment where it changes? And I just don't think it's in the next 2 or 3 months.
So there's a bit of a paradoxical dynamic at play here, in that it is true that while we saw equities making new year-to-date lows, or at least the S&P and the Dow did, you saw Bitcoin showing some strength. Now that a lot of this institutional crypto capitulation is out of the way, that I think in previous cycles and in a different macro environment, different monetary policy regime, probably could constitute a bottom. I think we could rightly say. But when you actually look at what's happening today, so, okay, Bitcoin's holding up, right? You have S&P making new lows, Dow making new lows, and Bitcoin's hanging out at, 18.5, 18.2, whatever the level is. Now, it's a double-edged sword, because then you have the S&P bounce 230 points off the lows in 2 days, and Bitcoin can't even hold 20K, right? So what this suggests to me is just at some point in the fourth quarter, and I do believe we have a pretty harsh breakdown coming in the equity markets, and we don't even stop at 35.85 or frankly even 3,400. I mean, I think we are going below there, and I am positioned for that starting today. you go look at, and Magoo, I know you're not, and I'm not a super chart guy either, but you go look at, for instance, just like the weekly chart on BTC, that thing's getting propped up. I mean, it's just rounding, hanging out here. It's going to, in my opinion, in the next 2 to 4 weeks, break down pretty aggressively from 20K. Maybe not in 2 to 4 weeks, but at some point this quarter, I do expect it to take that leg down because, look, yeah, maybe sellers aren't, interested in being huge participants here, but clearly there's not enough buying to take us for a meaningful breakout. Now that can change. Like, again, I don't have a crystal ball. But I don't expect, I just don't expect this level to hold here at, 18, 19, 20K, which we are. I mean, ultimately we're consolidating below it for the most part in the, mid to high 18s, low to mid 19s. We're spending more time under the 2017 highs than above. And so if we have a markdown on the S&P of 20 to 30% in a 4 to 6 week period, which I think is possible and probable, frankly, I just don't expect Bitcoin to hold. Now, what I do think can happen is it can negate some of the historical beta with which it trades the equity markets. So, right, the beta is 4 to 1 or something to that accord. I can see a scenario where the S&P marks down 30% and Bitcoin marks down 30%. And you could even see, equities continue to bleed out and Bitcoin firmly establishes a floor somewhere in the low teens. So I'm becoming increasingly receptive to that suggestion. But again, I just don't expect. Now, the relative strength on downside is valid to an extent, but we also need to situate that within the absolute carnage which crypto experienced in the first half of the year. So there's just not a whole lot of sellers left or selling to do. But nonetheless, I think, they will be able to manage one more pretty substantial leg down. And so, again, if you want to make the relative strength argument, you also have to acknowledge the relative weakness when we discuss the historical beta at which Bitcoin trades against the equity markets. So hope that wasn't too much of a word salad, but yeah, I mean, I don't expect 18, 19K to hold. It would be just from a market structure standpoint, from a technical standpoint.
Yeah.
This does not look like a bottom. This looks like something that will at some point in the next, like I said, 4, 6, 8 weeks, not exactly sure when, but that it will mark down aggressively. The last thing I'll say is, we rallied from 3,600 to 4,300 in about a month on the S&P, and all Bitcoin couldn't even hold 25K, right? I mean, I think we would have all thought it could go back and test 2830. And yet it was weak the entire rally, and alts outperformed it drastically, which is not something that historically aligns with a macro cyclical cryptocurrency bottom. So
yeah, it's just so hard for me to say this is a bottom, right? Like, one, capitulatory moments, like when we have reached the bottom, like show me one chart anywhere where the bottom has been like a smooth line of it just like constantly being there for like 2 or 3 months, right? Like there's always a high capitulative wick that is just like so far below, at least like in almost all assets, like not just Bitcoin's history, but like it's not just like, oh yeah, Bitcoin's just going to grind there for, let's say, like 3 months at just like 19, 20K, and then it's going to go off and do its own thing, right? Like you could see what happened in 2018. Bitcoin was grinding around 6 to 7K, and then all of a sudden it dropped from 6K down to like 3K, like instantly, right? So I don't see this as the bottom. I guess the real question is, like if you're looking to market entry, is like how low do you expect it to go, right? Like if it doesn't hold this, you could be left with some blue balls as well. There could be like when it breaks 18K, or if it breaks 18K and you're just sitting there on your jolly greens being like, oh, I can't wait to buy Bitcoin at 10K, right? And then all of a sudden it never gets there. Then you're like, shit, right? Then you realize you're kind of sitting there with blue balls, right? So you just got to be ready and prepared for that. Like if I was going to be buying into, let's say this wasn't the bottom and I wanted to do a market entry, I'd probably layer my buys all the way down, not trying to get too greedy with trying to be a hero and hero by the wick on the bottom. Because there's two things that could happen. One, you do that, and then it wicks another 20%. And you look like an idiot, or better yet, you actually don't get your full trade in, and you're sitting there as it's riding back up to 30K, not with a full position, right? So you got to be smart about it, because like, I don't want to sound arrogant, but it's relatively easy, or it has been in the past relatively easy to pick tops in Bitcoin, just because of it's so psyche driven and so much sentiment has driven the tops, and it's been relatively easy to be looking out into the market and being like, yep, that's the peak, right? Just seeing absolute cringe FOMO behavior, degenerate behavior. Whereas the bottom is probably 100 times harder to be like, yep, this is the bottom, right? Just because there's
I'd like
so
to
many things
ask
at
you
play.
about. I'm sorry to interrupt you. I'd like to ask you about that bottom in your opinion. So it sounds like your preferred method of being a bottom buying participant is to just sort of layer bids down. And I'm curious if you would disclose sort of where you are layering. And then one more thing to add to that question. I know a lot of Bitcoin OGs really don't like stable coins, and there's a lot of FUD around them and a lot of controversy. I guess if that's sort of a question in and of itself, like how are you bidding it? Do you believe in this stable coin FUD? And where are you layering those bids?
So let's address the stablecoin stuff first. So one, it really matters what stablecoins we're talking about. Each one of them has their own risk factor, and depending on who you are, obviously Tether has the biggest risk factor when it comes to regulation, in terms of like, is this backed, or is this going to be supported in the future? And then you have things like USDC, where they hold the biggest risk when it comes to that's actually probably just a CDBC. And they can freeze your funds at any given moment, right? So it really depends on who you are and what you're really looking to do out of it. If you're a clean cut, collared individual who pays Uncle Sam every single year exactly what you should be paying them, and you're not doing anything, being in USDC would probably make the most sense. And if that's not you, being in Tether would make the most sense. But even realistically, if you're a bottom, like most regulated exchanges now, you don't need to be in stables, right? Like if you are buying on FTX, or if you're buying on Binance US, or Kraken, or Coinbase, or Gemini, or Genesis, or let's just call it even Cash App and Strike and Swan, and all these places where you can buy Bitcoin, you can hold cash, right? Like you can hold cash. You don't have to hold stables, right? Most of the use cases for stables are to get yield, which could be a pretty good rug if you're not careful, depending on what you're doing with it and how much exposure you want to it. So realistically, if you're looking to buy the bottom in a regulated fashion, I don't think you need to be in stables to do that. I think you just need to have your dry powder probably ready on exchanges, one, so you can actually layer those bids and you have the funds, right? Unless
Magoo,
you
where do you buy your crypto, if you don't mind me asking?
I buy it at Genesis.
Okay.
So there's a couple things that allows me to do. Theoretically, I don't even have to have cash on Gemini or on Genesis. They're basically a T+1 settlement. So it's technically I can go to them and say, hey, I want to buy this amount of Bitcoin, and they will set the trade up, and the trade will be executed, and I don't have to have any cash in my account, period. And then I just settle with them at a later date. And the prices are good. So that most retail exchanges will not let you do that. You need to actually have cash in your account. And obviously Genesis has a lot better fees, right? But there's massive minimums, right? It's not for most retail individuals. But if you could get on there, I would suggest using them probably over anybody else.
What is the on there, Magoo? I've never considered using them, but I'm curious. You happen to know?
So for buying spot, I think the minimums are $250,000 per trade. And I think they only onboard clients with a net worth of 10+ million, if I'm not mistaken.
Unfortunately, I don't think I'll qualify, but maybe something.
Not yet.
Yes, something to work
Not
for.
yet. Not yet. You keep grinding.
Yeah, keep building the show.
But
we'll get there.
it's not even it's realistically not even it's mostly an institutional platform, to be honest with you, because like you're not going to find a retail platform that offers you like T plus whatever settlement. This is all qualified institutional stuff, where they can even feel comfortable to basically give you credit. Essentially, what it is. Well, that specifically in spot wouldn't be a credit, but if you're doing derivatives or something, there might be some credit that needs to be given. But realistically, it really comes down to what you're looking to do, right? Are you looking to own spot positions? Are you looking to own futures? Are you looking to own derivatives or options? Like what are you really looking to do? Are you looking like, but if like at the end of the day, the Bitcoiner, we want spot Bitcoin, right? Like we want spot Bitcoin and we want to take it off exchange and we want to hold it because we know eventually a lot of these institutions are going to implode in on themselves. Like, which people would probably call me crazy for saying that 5 months ago when I was saying it, but now they see exactly what can happen with the liquidation of cascading bullshit with people that are exposed to absolute criminals. And then everyone just ends up getting rug pulled, right? You had BlockFi, you had Celsius, you had Voyager. I even think Genesis had exposure to 3AC, right? So everyone in the industry had exposure. Just some people have bigger balance sheets than everybody else and are able to weather it, and other people had to get bailed out, right? And so don't think like this is human history here, folks. Like everything might not repeat exactly how it happened, but it always rhymes. So like this is going to happen in the future again when it comes to Bitcoin exposure. Someone's not going to be able to make post what they need to post, and people are going to get liquidated, and it's going to be a shit show all over again. I don't know when that's going to happen, but you can be guaranteed that will happen. So I like to
just circle back to one thing that I'm sure a lot of people in here are curious. Maybe if some of them don't follow you on Twitter, but where are you layering those bids to hopefully participate in the formation of the macro bottom?
So I'll probably layer some at the low of like whatever it was, 17.5, and then I'll probably put some in at 14.5, and then probably put some in at like 13, and then some at 12, and then some at 10, right? And I won't be mad. Like this so that's layering on the way down. You need to have a layering plan on the way up as well, because if my price targets don't hit, like I don't expect my 10Ks to hit, right? They're just there to be stink bids. And the 12K might not even hit, right? Like I don't know what's going to hit. Like this is all just probability, right? But if the market starts going against you in the other way, and you have a long-term bull thesis in Bitcoin, and the market starts moving you in the other direction, you can't hold on to the idea that the prices are going to go that low again if macro's changing in front of you. So you need to have a plan, be like, well, if it hits 14 and these orders gets filled, then it starts going back up. You need to be willing to pull the trigger, because if you don't, you're never going to pull the trigger, and you're always going to be waiting for those orders to fill. And then it's just going to be a mind game after there, and it's just going to fuck you. So you just need to be agile.
Magoo, let me ask you, I'm not sure what your time looks like, but if you would, you say your macro picture is dark. I mean, I know we've touched on it discursively, and I've offered, some thoughts as well, but paint a picture for me, if you would, about how you see the next 6 months playing out. I mean, we saw the initial, it was probably ultimately a bit of a FUD event, the Credit Suisse thing, but I think as the market comes to terms with the realization that rates are almost certain to stay elevated for longer, and you see non-US countries struggling, whether it be with pension funds, sovereign currency, sovereign debt markets, whatever it may be, how do you see this playing out? And what do you think? I know I asked you what you think things look like in 6 months, but specify a bit, if you would, about the characteristics of what ultimately drives prices lower.
So there's a couple options that I think could happen. There's the bad option, then there's the really bad option. I don't really have a case in my head where I can't even imagine where we've hit the bottoms yet. So realistically, I see us basically continuing to raise rates in November, whether it's 50 or 75 basis points, and then December probably another 25 or 50 basis points. And then the market's grinding lower as that happens. And then we're going to see corporate earnings starting to come down in Q3 and Q4 as well, which will compress the PEs, obviously, because their earnings will be going down. So the PEs will need to go in line with that, and the equity prices will go down. And then real estate is really going to start to, I don't want to say fall off a cliff, but it's already started to roll over. But I think it's going to start to roll over even more so going into the fourth quarter, because it's just, you see mortgage dealers, I don't want to call them mortgage dealers, but like refinance divisions inside of banks getting laid off, like full refinancing teams just getting fired.
If I may just to clarify, are you talking about like real estate as a whole? Or are you talking about single family homes or investment properties?
Probably everything in general, just because it's so elevated. Let me just pull up here. I'll pull this up on the chart. US average house prices, and just looking at the trend, average, let's see here if I can get a good chart up here. Medium sale price. This is from Fred. So Fred Economic Data, St. Louis. So if you look at the trend from all the way from 75, and it just keeping trend, and then obviously Q2 2020 starts, the average single family house sold in the United States for $320,000, and right now it's $440,000. Like, it's literally just went up on a mountain, right? That trend can't continue. You're going to see some mean reversion. How low can it go? I don't think we're going to have a 2017 moment, but we're going to have a meaningful correction in real estate across the entire country. Some markets being more affected than others. Some of the hot markets like Miami, New York, San Fran, Seattle, and
Austin, Texas.
Yeah, Austin, and then you have north of the border, you have Vancouver, you have Toronto. That market is completely ridiculous, and so I think you could see in some markets like a 30% correction in prices, and that is a big problem.
No, I want to just interject quick, if I may. I agree with you that the housing market is due for a massive. I mean, it really just comes down to nobody purchases homes in cash, and everybody's borrowing. And the fact of the matter is, you could have bought a $600,000 home with a mortgage of $2,500 a month back in April, and now you buy a $400,000 home for that same monthly cost. So, basically the sellers out there have to come to terms with that and drop their pricing, or the market just doesn't transact. However, what really screwed things up in 2007 was an overall capitulation. These were people buying homes within 1 or 2 years of that capitulation event, and they were forced sellers, which really accentuated the issue. Right now, I don't think we're going to see a single family home capitulation. We will see a drop in prices. But the drop in prices is mostly going to be people that have owned these homes for a long time that are transacting for other reasons, because the people that bought at the peak of the market are locked in at, potentially sub 3%, 30-year fixed rate mortgages. The real estate niche that I'm really concerned about is like the multifamily wing. And a lot of these multifamily investors were aggressively refinancing their existing holdings, borrowing as much as they possibly could from their lenders just to redeploy and buy multifamily buildings at sub 4% cap rates when their rate is only locked in for 5 to 7 years. So if this thing extends for potentially a decade and their rents have to drop, and there's so many things that can go wrong that would cause these assets to be not as like premier and stable as they used to be. And if, for one, you can buy a 2-year note guaranteed by the United States government that's going to yield potentially more than you paid for an apartment building 2 years ago. So when I look at those guys that were happy to borrow money at 3% to buy a 4-cap multifamily building that is not guaranteed by any strong tenants, it's just a bunch of $50,000 to $100,000 a year earners that will be impacted by a global meltdown. I mean, those are the people that I'm really worried about, and I think are going to capitulate. The single family homes, I don't know if I see the capitulation event there yet, but I'd love your thoughts.
So you're spot on. The only caveat that I would add is that I had a tweet about this actually in early July. And this is where I think the capitulation could potentially come from in the real estate market. So in January of 2021, a 30-year mortgage rate was 2.65%, and the average house price was around $400,000, which equals almost a $1,300 a month mortgage payment. Today, 30-year mortgages are at like almost 7%, and the average house price is almost 600,000. That's like your monthly payment is now close to $3,000 a month. And that differential there is what could cause a capitulation moment from people to walk away from their houses, that people that already live paycheck to paycheck, and you're telling them that they almost have to more than double their mortgage payment, and they just can't do it. There's no way for them to come up with that money. So there's only a couple things that you could do to fix that. Realistically, is you hand in your keys and you give them to the bank, and you walk away from your house because you just can't pay it. The banks don't want that because realistically, they don't want to be stuck with all this real estate like a 2007 moment. The only other thing is to basically re-amortize people's mortgages. So if someone's on a 30-year, you might start seeing banks come out with 50-year mortgages and being like, okay, you can't pay this $2,800 a month. We'll turn your 30-year mortgage into a 50-year mortgage and keep your payment the same, right? That's the only way that they could rescue what would happen if these people can't pay. And there's going to be a lot of them, right? And like
I started to see that in the investment sector in real estate, these 35-year AMs that they just recently started offering.
Yeah, no, exactly. And I think they're already talking about it in Canada. Like I know the real estate markets in the United States are a little bit different. But I actually have a buddy who's a real estate agent in Canada, and they said they're already talking about with their mortgage providers and their banking partners, basically that they're thinking about shilling 50-year mortgages because they talked about the specific problem that I just talked about, and that there's nothing that these individuals can do. Like if you say, hey, like, because I believe in Canada, like you don't have fixed terms. Like it's not like you have a 2.65% for 30 years. You have like fixed for 5 years or 10 or 5 years, and you have to refinance. And so those are completely always rolling off and on. And so there's people by the day that are being told that their payments just more than double, right? And most of people live paycheck to paycheck, and there's just nothing you can do. You're like, there's nothing I can do to come up with an extra $3,000 a month or an extra $2,000 a month, right? And that can happen in the States too. So that's where I think the risk factor lies with single family housing.
Magoo, one of the things that I suppose just maybe that I admire and respect about you is that you, I mean, you know, you're transacting on an exchange where you have to have an 8-figure net worth. So, I mean, you are, you know, extremely wealthy. One of the things that, you know, again, I should say maybe that I appreciate about your outlook on the market is that I think typically the wealthier people are in the online finance and crypto space, the more it seems that they're just like, oh yeah, the bottom's in. Oh yeah, the bottom's in. And I think it's really because they just want the bottom to be in, where for 10, 12 years, whether it was in traditional equities or Bitcoin or the cryptocurrency space, they're just used to most dips not lasting that long. And you could find something, you could, I make this joke all the time. It's only half a joke, is that you can just kind of Google stocks down most from all-time highs. You can go find them. If they're consolidating, looks like they're putting in a base, you can just kind of lever up and buy them. And they can be a completely worthless company that just doesn't warrant the valuation at which they trade at, even at depressed levels. The reason I say this is because, you know, you often very adroitly point out that a lot of these, you know, lower end families and working class communities in the United States and Canada, but, you know, really the United States, they can't afford to live in the current, you know, fiscal regime we're in, where, you know, you can just kind of deal with your grocery bill being up 30% more. You can deal with used cars being up 30, 40, 50% more, right? God forbid you have an adjustable rate in the housing market. I mean, you're done. And so it's just something that, I think you're wise to point out and be cognizant of, despite the fact that you yourself, these are negligible for you, minimal differences in price on a nominal basis. But understanding, I mean, you've used this before. We went to the extremes with COVID, and I've kind of piggybacked on what I'm about to reference, a previous point of yours, is that, we went to an extreme with COVID in terms of a ZERP environment where real rates were overwhelmingly negative, printing a ton of money, and a central bank, a Federal Reserve that's, stepped back despite material signals of rising inflation and just ultimately ignored it. And so you have that extremity on one side of the continuum. And then on the other side of this spectrum, that's where we're heading towards. And so I often have used the phrase, we're actually in macro mean reversion. This is the process of things coming back down to earth. And a lot of it seems like just, some of the mid to high 7 figures, 8-figure, 9-figure people, it seems like many of them are just absolutely confounded at the fact that asset prices are in a sustained downtrend, and that the investor environment is not the same now that it was in 2014.
Yeah,
and
that's where everyone's getting this wrong, and why they've basically been wrong for the last 6 months, and it's probably why they're going to be wrong for the next 6 months, is because they think we're living in the same macro environment that we've lived in since the GFC, which couldn't be further from the truth. And that's why people that were calling long bonds to go long bonds have gotten repeatedly wrecked, right? Because they thought we were going back into a ZERP right away, and it was just going to negative rates, when that just isn't the case, right? And so they're going to continue to be wrong until they've actually readjusted their heads to actually realize that this is not the same macro environment that we've been living in, right? Like, we can get into the long-term debt cycle if you want to, or we could save that for another time. But there's a lot of things that are lining up here, whether you want to call it the fourth turning, the long-term debt cycle. But there's a lot of things that are happening here. It's not a coincidence that Russia chose its particular moment to cause a ruckus, right? It's not a coincidence, right? There's things that are at play here that have always been destined to happen because of how the debt cycles work as well. And we can get into that if you want, but people just need to realize that we are in a different type of environment, and yesterday's rules aren't going to be today's or tomorrow's rules.
Yeah, I mean, look, whatever you want to talk about in terms of what the future is for Bitcoin, you've spoken sparingly on Spaces about your outlook on DeFi and the institutional commandeering, that is TradFi commandeering of, ostensibly decentralized crypto networks. I just want this to be the Magoo show. So whatever you want to talk about, you want to talk about the next 5 to 10 years for BTC, you want to talk DeFi. I mean, look, I don't have really a time limit here. I'm more just respecting your time limits because I understand you're very busy. But really, man, just let's get into the nitty gritty with crypto if you'd like. And let's just, talk to me about how you see Bitcoin situated in the context of this macro debt cycle we're in. How you see the rest of crypto playing out. I'm very bearish on crypto. Crypto's a fucking scam, dude. It's a bunch of worthless Ponzi's, other than Bitcoin, of course. So just take it away, man. Whatever you want to talk about.
Yeah, let's start with our famous quote unquote DeFi. So I think maybe some people got a slap in the face. Maybe they didn't. Maybe they're still sleeping when it comes to Tornado Cash, right? Everyone that doesn't know, for your listeners, what Tornado Cash is, or should I say was basically a way to anonymize your, let's just call it, for lack of a better words, Ethereum accounts, because it could be any CR20 token, but you can anonymize basically moving funds around, so you could basically not have your identity linked to you, or your financial identity linked to you, while you're moving your assets from account to account. A little bit different than Bitcoin, because Bitcoin's a UTXO-based system, whereas the Ethereum network is an account-based system. And so it allowed individuals to basically mask their history, their financial history on the blockchain that is Ethereum. And their whole slogan at Tornado Cash was decentralized, 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 right? And we've seen Tornado Cash wiped from the face of this planet within less than 24 hours. We've seen the Treasury Department basically issue warnings and basically it's a criminal offense to use Tornado Cash as a U.S. person. There's that. You've seen a coordinated effort across technology providers. GitHub completely wiped out the GitHub repository of Tornado Cash itself, and also the users who committed code to those repos. Those accounts got deleted. And so a lot of people got a fresh wake-up call into quote unquote what is actually decentralized. And they found out that, guess what? Tornado Cash wasn't decentralized, and it could be attacked, right? And I'll lump that in with DeFi because it's the same adage, right? You have things like Uniswap Labs, which is a VC-backed corporation that is the power behind the protocol Uniswap. That is not decentralized in any sense of the manner. When you have a very centralized entity, an actual organization that has stakeholders that are controlling the protocol, you'll have people say, well, once they release these smart contracts, they're immutable and anyone can use them, and nobody on Uniswap can stop you, or Unilabs can stop you from using those smart contracts that they deployed. But what people don't understand is that, one, there is the ease of use, right? If Uniswap releases a GUI that allows you to interact with these smart contract protocols in a very easy fashion, that's already about 95% of the users that are just going to use that interface. And so whatever they put on the interface is basically what is going to get used, right? So if the US Treasury or some regulatory body says, hey, we don't want you having this asset on Uniswap UI, the smart contracts underlying might exist for you to trade that asset, but their UI is not going to support that. So that already makes it very, very unreachable for 99% of the population. And then on top of that, another thing that is very centralized within the DeFi community is the liquidity providers. What most people don't understand is that some of the biggest liquidity providers in DeFi itself is US regulated financial institutions. If regulation comes down, and they basically say, you are not allowed to be a counterparty to customers that are not KYC'd, meaning you're not allowed to provide liquidities to these dark pools, which are the DeFi lending and borrowing pools or whatever the trading pools at Uniswap. You're not allowed to do that, or else you're going to jail and your company's getting shut down. You're going to see liquidity just dry up for the unsanctioned quote unquote tokens or protocols. And that is going to kill off those protocols and those tokens just by the very nature of not having liquidity, right? Like that's why dark markets or black markets don't flourish. It's a lack of liquidity, right? And that's what Silk Road tried to bring to let's just call it the drug market, taking it to the furthest extent. And look what the regulators did. They absolutely wiped that from the face of the planet, right? So they have a lot of ways from Sunday to fuck you. And I just think there is a lot of ways in the DeFi ecosphere and the whole tokenomics and the whole system where they can pick at very centralized entities that are in this model, which are going to collapse any notion that it is DeFi. And I think probably by the end of the decade, you're going to see most of the majority of the major DeFi protocols are going to be KYC. Which you might think, well, what the fuck is the point of DeFi? If you have to do KYC, you have to do all this stuff, right? That basically takes out about 99% of the people that are using DeFi today. Most of the people that are using DeFi today are doing it for degenerate gambling, or they're doing it for KYC arbitrage, right? That's the only reason why that they're in there. And it's pretty simple to know that. Because no one would be sending a transaction of economic intent to paying a $30 transaction fee on Ethereum, right? The only way you would ever do that is if you believe you're going to get a bigger return on the other end of paying that transaction fee. And so that lets you know that probably close to 100% of all the transactions that are happening on there are speculative in nature, right? And some of them are probably going to be more nefarious where people are doing KYC and AML arbitrage. And so if you take out that use case, one, the user base gets dwindled drastically. You can talk about how there might be able to be efficiencies found in these DeFi protocols by financial institutions and regulated bodies and people that are KYC'd. It might actually add some efficiencies in that marketplace. Whether that brings value to an underlying token, that's a whole other story. But by the very nature, DeFi protocols that can comply are not decentralized, right? And so the ones that are, the ones that are going to comply are the ones that are centralized, and those are the ones that are going to win out because it's all going to be favoritism with regulators,
dude,
right?
Magoo, let me listen. I think you'll be down for this, man. Let's FUD some ETH, man. I don't really like Ethereum. I think the community is pretty bad. Let's just FUD ETH and shill Bitcoin because I'm a maxi. Like there are degrees of maximalism. I just can't tell you with a straight face. I mean, I guess I can understand where token value is derived from on Ethereum, but in terms of me making like an actual investment on something I'm 100% fundamentally on board with, the only digital asset I can do that in good conscience with is Bitcoin. Okay. I don't really care. And you know, now the censorship that Ethereum is pretty willingly participating in, you know, I'm just not on board with that, right? I'm censored right now from Twitter. Like I can't get on Twitter.
Bad boy.
Well, but not even. I mean, a few freaks can just decide they want to just, you know, try and affect my well-being. And now here I am. Now, again, it's working out. I'm a guy who makes the best of things, but let's just, let's just FUD some ETH. Like, let's FUD some ETH and let's shill some BTC.
Okay, I got some BTC wrapped on Aave right now, so don't FUD it too hard, okay?
Oh boy, this guy's about to get rocked. No,
but hey, the reason is I'm not degenning it. I have conviction that, you know, my Bitcoin, my wrap BTC stack will appreciate with time. I'm very minimally leveraged on it. I'm over collateralized on it, and my hope is that I can draw low interest debt against my wrap Bitcoin, and Bitcoin will trend up with time, and I can continue to draw against it without the tax implications of actually selling Bitcoin. That's why I'm doing it. I don't know what you think about that strategy, Magoo, but that's sort of like our CeFi utopia right there.
Yeah, I currently think that strategy is picking up pennies in front of a freight train. Just because of the counterparty risk that you have with wrap BTC and especially with Aave. Once Bitcoin monetizes itself, obviously it's going to be a very big use case. Like all the big wigs, I'll just call them big wigs for lack of a better word, is they basically use their financial assets to basically borrow to get cash without ever having to sell their financial assets because they're appreciating faster than the interest rates that they're borrowing at, and it leaves you in the situation of getting tax-free money, right? Like that's what Donald Trump does with real estate. It's what Elon Musk does with his Tesla shares.
Literally every billionaire.
Yeah. What's going on the road? I just don't think we're at a point yet in the Bitcoin space where the counterparty risks are small enough to where that makes sense. And also not only the counterparty risk, but the capital gains that you're going to be getting on Bitcoin are going to make those interest rates look like you're going to shake your head at why you're doing this, right? Because I still think over the next 10 years, Bitcoin has definitely at least a 10x in it, if not a 20x, right? And like to get to do that at this point, to me at least, it's just not the risk reward factor is just not there. But if we want to get into like an ETH, let's call it an ETH FUD session here.
Let's do it, man. Let's do it. Let's FUD some ETH.
Yeah. So let's get into what Ethereum. I don't even call them Ethereum maxis, but let's call Ethereum diehards that really think Ethereum is going to beat out Bitcoin in that zero-sum game of being money, right? Most people that actually understand money and understand the problem that Bitcoin and Satoshi actually solved find that pretty laughable. But let's get into it. So you have Ethereum, it's not him. Hopefully it's not. Who knows? Ethereum in the metaverse, anything can be anything. But Ethereum was developed and designed to be a decentralized smart contract platform, right? Whatever that means, right? First, it was the world computer, then it was the ICO platform, then it was the NFT platform, then it was the DeFi platform. Every couple of years is a new narrative, which is fine, right? Like it's just latching onto a narrative and then sucking in FOMO, whatever. That is whatever. The problem on the technical side is anyone who is an engineer who has developed very large systems in an enterprise fashion or in a very large fashion, you know that when you design to build something, you design it to be that thing, not design it to be one thing and then shift and then start changing. As the narrative changes, your engineering changes, because at the end of the day, that will leave you with like a popsicle stick house with you're building on, oh, we need this expansion, we need this, but you initially didn't architect for that, right? So that's an underlying flaw that they're going through now. They're having an identity crisis, in my mind, where they want to be the meme, they want to be Bitcoin, they want to be sound money, but they also want to compete with Solana, Cardano, and all these other smart contract platforms as a smart contract platform, right? And any good engineer knows that you can't design your systems to be the best at those two things. They're just not congruent with each other. And they're having this identity crisis thinking that they can do both. And I think it's actually harming both of those use cases that they're trying to do, right? You have Solana, who can't even keep their stuff running for more than 5 days without going down. But the market is willing to put up with it because Solana adds efficiency. What the market is telling us, at least the smart contract users and the applications that are currently working on smart contract platforms, is that they're demanding efficiency. They're not demanding more decentralization. They're demanding higher throughput, cheaper fees, more functionality, more capability to do different things on them. They're not asking for decentralization. And so lo and behold, you have Solana come about, who's a less decentralized version of Ethereum, but it's faster, right? It has more functionality, at least in theory. Whatever is out into production now is a different story. But in theory, if you look at it, Solana can do more things than Ethereum can, but it's more centralized, right? And Ethereum, looking at that, is you have people on the Ethereum camp who want to continue to compete with Solana and the smart contract platforms. And they're pushing Ethereum in one way and making it more centralized, going proof of stake and not staying proof of work, going to sharding, needing massive sharding nodes to accomplish that, right? And then you have the other people on Ethereum who still want that meme of ETH being sound money. And they're like, oh, guys, let's burn fees. Let's say we're deflationary, right? When in the very theory of an efficient smart contract platform, you need there to be an abundance or a reduction in fees, so people actually want to use your platform. But if you're destroying the supply, you're going to increase the fees that are going to be happening on Ethereum. It's like this whole catch-22 of this identity crisis where they're just colliding into this massive malformation of like technology, which is Ethereum. They really need to make their mind up on what they want to do, because no matter what they do, they can't beat Bitcoin at being money, right? So they need to realize that they're a smart contract platform, and they need to be developing it as a smart contract platform, right? So they're in a tough spot because, and let's talk about why I don't think fundamentally why any smart contract platform can be the world's money. So these at the very base are technology platforms and technology products, right? And they're going to be in this everlasting cycle of competition with each other, which means constant innovation, right? To kind of pose an example, if you look back to the early 90s, or I guess the late 90s, when you had like IBM, you had Dell, you had HP, all competing with each other basically to make better desktop computers and cheaper desktop computers. This is the same thing we're seeing now with Solana, Cardano, Ethereum, all the Polkadot, Polygon, all these other smart contract platforms, is that they're in competition with each other, and they're having to continue to improve every single day, or they're going to be lapped by their competition. Now, what does that mean on a technical level? It means that your code base has to be in flux at all time, and it can't ever solidify, because as soon as a smart contract platform code solidifies, it basically allows its competitions to basically outcompete it and catch up and then surpass it. And what happens? And so you obviously don't want to do that, right? Because as soon as you solidify, you're going to get overtaken by your competition, right? And if you don't ever solidify, no one's ever going to deploy capital in a monetary fashion to a protocol that is ever changing, right? Not even just talking about the monetary policy of Ethereum or any of these other smart contract platforms, just the solidity. Well, that's actually not a pun, but like the foundation of the things, if it's ever changing, no one has any confidence to put any type of capital into this structure. The reason why you see international organizations, international countries actually adopting Bitcoin is because it has solidified to a point where it's not changing. You can't say that about Ethereum. Ethereum literally just did a massive fundamental change to its consensus model, which we still don't know is going to be good in the long run or not. It might be, I don't know. That's totally possible. It's going to be making it a little bit more scalable, but there's nothing to say that Ethereum's ever going to stop innovating. And if they do stop innovating, they're going to get beat out by another smart contract platform, right? But if they don't, they're never going to be money because it's not going to be solidified. So they're really in a catch-22. And that really, really solidifies it in my mind that Bitcoin's just in a completely different realm than any of these smart contract platforms, right? And then you can make a case that smart contract platforms are needed. And if you can make a case for the token to have value, that's fine. That's not my job. And to me, that doesn't interest me. Because realistically, what you're looking at is Bitcoin as money. You're looking at one fish in basically a $200 trillion pond, where these smart contract platforms, you're looking at many fish in like a $10 trillion pond at best, right? So if you're looking at it in terms of an investment, why would you want to invest into something that has lots of competitions and the TAM is so much smaller than Bitcoin, who has no competition and the TAM is exponentially larger, right? It's just that people now have the misconception that they think Ethereum is going to be the internet money, right? Ethereum is already US chain, right? Like after what's happened with Tornado Cash, Ethereum has been co-opted by the United States, in my opinion. And that's not to say that Ethereum has no value. But once you get co-opted by the government in the United States as a whole, that limits your TAM, right? Do you think Russia is going to want to use Ethereum and store value on Ethereum? No, because it's all controlled by AWS and Circle. We can get into that in a second. These other international organizations and countries are never going to want to invest in these very centralized to a country smart contract platforms, right? So, and if you want to get into Circle, basically you have an entire protocol which is Ethereum, and all the DeFi market is completely built around stablecoins, USDC for the most part. Who is USDC controlled by? Circle. Who owns Circle? BlackRock, right? Like it's the traditional legacy system that is controlling Ethereum, right? Like let's say Ethereum wanted to fork and Circle said, no, we're not going to support this chain. We're going to support this chain. Who do you think is going to win that? Do you think the people that are using Ethereum, we want to use this chain, and Circle says, well, all those USDC tokens on this chain, we're not supporting them. They're not getting redeemed. That's an incredible amount of power when it comes to consensus, right? People don't understand. So overall, I think it's just way too centralized to be a world money.
So I'd like to, and that was fantastic, by the way. I'm just gonna say bravo. I don't even need to counter you. I can only probably counter maybe half of that and even pick your brain out. That was so like right curve. Our followers absolutely love that. The comments are great on that, and I love listening to that. But I'd like to just, instead of like the why Ethereum doesn't work, I'd love to just talk about like why, because Bitcoin, well, not because Bitcoin, that's us, but why Bitcoin will work, and what does Bitcoin look like for you in the future?
So I guess the one thing that Bitcoin has over any other protocol is I call it the three pillars of consensus. You have the miners, you have the nodes, and you have the basically the hodlers, right? The people that benefit the most from the network. And people might think that miners control the network. People might think that nodes control the network. People might think that people who hold Bitcoin own the network, but in reality, it's a combination of all three of those, right? Like in Ethereum, now that they're in proof of stake, the validators and the miners are the same people, right? Like you just compressed your consensus right there. So the very people that are actually benefiting from token issuance are the same people that are validating the blocks, right? Like it's just like it's kind of funny. And where in Bitcoin you have people that are validating the consensus rules, so the node runners are not the people that are mining, right? And so you have a separation of concerns there. And then you have also the other less quantifiable influence with people that actually hold Bitcoin, right? Because like if you look back at 2017, it wasn't just the miners or the node runners that decided about the block wars. It was very influential people with a lot of Bitcoin that decided on what chains to support as well, right? So there's kind of a triad, I'll call it. No pun intended there, what's going on in Ukraine or Russia, but it's a triad of consensus.
And how do you see this triad of consensus actualizing over the next 5 to 10 years?
So I guess I'll start off with the miners. I think miners are actually probably they have so much synergy with energy companies in general. I think probably within 10 years you see self miners probably go away, and you probably see a lot. I don't know what happens. Either mining companies buy power companies, or power companies buy mining companies.
Oil and gas
Yeah,
companies.
yeah. Anyone that can generate power, there is such a synergy there. Not only just from power generations as well, but the capability of Bitcoin for using stranded energy. You could, if you want to play with the ESG losers, which I'm not a huge fan of, but you could do a lot of damage there, no pun intended, with playing them at their own game, with basically capturing flare gas or just anything, basically generating ESG tokens. Let's call them ESG tokens, right? So there's a lot of synergies between energy companies and miners that I think is just going to make the mining industry that more fruitful and that much more big. Like it's just gonna grow, right? And then for realistically, you're going to start seeing probably nation states probably having their own sovereign miners at some point, maybe not in the next 10 years, but eventually far out, you're going to see them. Because at the end of the day, they're going to need to secure the ability to get blocks into the blockchain, because there is economic warfare that could happen, right? Like if you think the majority of the miners in 2050 are going to be inside the United States, that's actually bad for Bitcoin, because what that means is it means that the United States with political power can force miners to exclude certain transactions from blocks, right? Whereas if Russia tried to get a block into the chain and all American miners were not willing to put that block in there, then Russia's not going to want to use Bitcoin anymore, right? So you're going to see an incentive for countries to actually develop their own mining to ensure the security of national security to get transactions into the blockchain. When it comes to Bitcoin adoption, I think it's just going to continue to grow. Like even now, like not to take it back to mining, but like the price is going down, but the hash rate's going up, right? Like that tells you someone's pretty goddamn bullish on it, right? When you have energy prices at all-time high, and you have Bitcoin prices at relatively pretty big lows, the margins are pretty goddamn compressed for miners. But guess what, boys? Hash power is still going up. So that means people are goddamn bullish on mining. And that means they're goddamn bullish on Bitcoin into the future, right?
Does the future is the future comprised of people transacting in Bitcoin, or is Bitcoin a store of value that you basically just lock away and it appreciates with time?
So I think over the next 10 years, you're probably going to see it be more the latter of just that being a store of value. I think there's going to be an S adoption of like a S curve adoption where you're going to see Bitcoin monetize over the next 10 to 15 years, where you see that initial adoption. And then there's potential for it to basically have a flat curve of adoption for probably the following 10 years, where it's just getting saturated into the system. And then fiat currencies at that point, not all of them, but a lot of them will start literally dropping like flies. And then there's going to be a necessity to being transacted with Bitcoin. And then also the technology with lightning and channel factories and other third layer and second layers of transactability will be there as well. So I think that's how it's going to play out over the next 10 to 15 years. You're going to see the monetization and the store of value narrative play out. And then you theoretically could probably see 10 years of not too much adoption in terms of transacting, but it just like filtering its way through and trickling into the financial system and the planet in general. And then you're really going to start to see the next leg up, I guess, which would be in like 30, 40 years, where it really starts being a daily driver. Once the necessity and the technology is there to support that, where people start saying, why would I want to take a euro? Why would I want to take a Argentinian peso? Why would I want to take a bolivar? Why would I want to take a franc? Why would I want to take this when I could take Bitcoin, right? When that really starts playing out and the volatility is dampened extremely, people are going to be more willing to take it and transact with it on a daily basis. So I think it's going to be like an S curve on adoption. Most Bitcoin bulls are smoking crack cocaine when they're talking about the US dollar imploding next year and Bitcoin's going to $2 million in 2 years. Like, no, that's not going to happen, right? And you actually better hope that doesn't happen, because if the US dollar collapses in the next 2 years, you're probably more concerned with how many bottles of water you have in your basement and bullets you have in your gun than you do about how many Bitcoins you have in your hardware wallet, right? So the bull case for me is you want there to be a secession plan, right? Like, you don't want it just to be a vacuum of power, because that's just a very volatile world. And with volatile world, and not to kind of point back to the current day, but like with a volatile world and a vacuum of power with nuclear bombs at play, it's not a pretty picture, right? So you want to have a gradual secession from the fiat system to the Bitcoin system. And that's decade plays. That's like 50, 60, 70, 80, 90 years out. That's not like a couple of years down the road, folks.
Magoo, one of the things, and maybe we'll go another 5 minutes or so, and then we can wrap up here. But Magoo, one of the things, I really firmly expect Bitcoin, when we move off this macro bottom, whenever we reach it, assuming we're not there yet, I really anticipate Bitcoin to be a leader and to continue aggressively appreciating against traditional equity returns, even real assets, right? The reason for this is because I think you and I share the skepticism that, the Fed is going to reach 2% year-over-year inflation in a healthy way that's not going to severely damage the economy. So I think, again, based off what this data indicates, is that our best case is that we get to something like 4 or 5% maybe, and then something in the economy just fundamentally breaks and causes some sort of real short-term meltdown. We know what the end result is, no matter what lows are in, even if they already are in. The end result here is continued, perpetual, perennial debasement of sovereign currencies and sustained reduction of purchasing power for people who, transact primarily in fiat, or I should say more acutely, denominate their net worth in fiat. And so Bitcoin, when you can have the British pound trade like a Binance shitcoin over the span of a couple of weeks, the use case for Bitcoin has never been more clear. The inherent value of it, because of its absolute scarcity, because of what it represents. And so I'm not here, like, I joke around. The audience all here know, I joke around all the time, say crypto's a scam. I joke about Bitcoin going to 3K, right? I mean, that both of those comments are tongue in cheek. But I don't want there to be any confusion that I'm extremely bullish on Bitcoin from a fundamental aspect. And when the money printer comes on again, I think right, where do bond yields have to be to make bonds an attractive buy? Like, do we see yields going back to 0.5%? I don't, I don't. It would take, a really surprising sequence of events for the economy to sort of healthily make its way back to a pre-COVID reset. And so in this new investor landscape, To me, Bitcoin just makes the most sense. Like I plan to, when I feel like we've reached a bottom, I plan to allocate north of 95% of my net worth in spot Bitcoin on cold storage. It is what it is. The way I see it, if I can have, 20, 30 Bitcoin, which isn't a lot to some people, but to the average person, that's quite a lot, especially when you consider the targets for 5 to 10 years down the road. I'm more than comfortable to watch that appreciate over the span of 5 to 10 years, work on building this brand, do some trading. Sure, I'll take 5% of my net worth and speculate on worthless altcoins if and when that time comes again. But anyways, long-winded way of saying that I really expect Bitcoin to lead, because I think in the new environment we're transitioning into, and will certainly be in 2023 and onwards, Bitcoin will only be more and more sensible as an asset that deserves allocation in the way that bonds conventionally have, right? And when we talk about a spot ETF, passive inflows into BTC, a reduction of volatility. Now, of course, the law of diminishing returns will probably apply to some extent as well, but nonetheless, I expect it. What I'll end with is I expect it to have what is a trademark characteristic of every sort of commodity expansion, dating back to as far as the 18th century, but certainly like you could see in gold in the latter half of the 20th century. You just see an expansionary period where it's revalued en masse by the market, and so I fully anticipate that to play out over the next 5+ years.
Yeah, no, 100%. And some people get it, some people don't. I don't know if you guys know who Deer Point Macro is, but the other day I asked him, I'm like, why do you think Bitcoin has been the number one performing best asset over the last 10 years? And he's kind of a statist Keynesian school, and he quoted me basically, tell me where the 1 year inflation swaps are trading, right? Like he actually fundamentally believes that inflation doesn't exist. Like it is hilarious to think that, because all you need to do is look at your grocery bill over the last 7 months, let alone 10 years. Like things are going up in price, and we need
isn't he like really bull? I've spoken with him a couple of times. Like I will say he is very well versed on the macro, to the point where like I can't in good faith say that I've rebutted him on anything or repudiated him. He is certainly a very intelligent guy, so I don't want to disrespect him, but I preface what I'm about to say with that, because I don't want to misrepresent his investing positions, but I believe he's like very, very bullish on bonds. I'm not sure if you have any insight into that. I can tell you, I won't be purchasing any bonds at the bottom of this cycle.
Yeah, I'll leave it at that. I will not be buying long bonds here. Like that's a sinking ship, right? Like this is who we talked about at the beginning of the episode. I don't want to go down a rabbit hole here at the end, but like those people have been saying long bonds since like 2% or like 1.5%, and here we are, right? So they're definitely underwater on those trades.
Well, and the thing is, people have tried to go long bonds via options, and no matter what people say, like I am a native options trader. I work with people privately, help them position in 6 and 7 figure options positions in the equity markets. I know what premiums do. I can tell you, if you've been long bonds, just from a premium perspective, you are getting like big boy decimated. No matter what people say of like, oh, I give this enough time to play out. When you sit through that kind of carnage, and these people have been bullish on bonds since Q1. I mean, let's not forget that the long bonds trade was not like, something at the June lows. These people have been bullish on bonds the entire year, and they have tried to fight the Fed. I can't even imagine what a position for even 2024 looks like now. And to be fair, like you probably will like make some money on that position. I mean, inevitably we probably will see bonds come down. It's just like, is the 10-year going to go to 5.5% first? In which case you are going to be so underwater. You better hope that they actually do go out and buy bonds. You're going to need a deflationary event for this to occur, because there's not going to be an organic return to bonds without one. And this is what I think people fail to understand. But back to my primary point here is that I can tell you guys, this whole long bonds trade, whatever instrument you used, I mean, it has to be options related, unless you're just like boomer, allocating to bonds, which is fine, I guess. Like if that's If that's your cup of tea, it's certainly not any of ours, but it should be stated in no uncertain terms. If you have been long bonds, anyone saying anything other than that they've gotten they've gotten their ass absolutely kicked in that trade, they're lying. It's that simple. I would wager these trades are down to the tune of 40, 50, 60, 70%. Like, you are getting destroyed, and it's going to get worse because even if headline CPI is peaked, which I think is possible, it doesn't matter if in December we're still at a 7.5% year over year CPI rate, which is probable, given that OPEC is, actively reducing oil output, and every time the fucking stock market goes up, it's outpaced by commodities and oil. You have oil starting a leg up. Brent and crude are both going back to triple digits this winter, barring some sort of extreme shift. We've emptied the SPR as a midterm ploy. That can't last forever. So, I just wanted to add a little bit of commentary there. That long bonds trade is idiotic. There's going to come a time for that, and it's when deflation comes. Sure, you probably will see yields come down, but you'll see yields come down from 5.5%, 6%, not 3.75. Okay. People have been, I don't understand why I don't know. I don't want to turn this into a Carter, rant. The MO is and remains to short tech on bounces. It is that simple. I mean, it really does not need to be any more complicated than that. Make bearish bets with enough time to be right on bounces, understand how options chains work, and bet on the cost of capital, deglobalization, geopolitical instability, rising expenses to transact internationally, right? Bet on these things to continue to eat away at tech companies' capacity to grow with a deteriorating lower end consumer globally. While international central banks strike the most hawkish monetary policy in 30 years, right? It's not a complicated trade. I don't understand, but everyone has to be people think like shorting the market, you're trying to be some George Soros, Michael Burry. No, my friend, you are, by trying to long bonds in an environment where yields are still beneath year over year CPI prints, and they're not meaningfully coming down in any way. So I just had to add that in real quick because it really kind of gets at me how everyone thinks they're this little genius for longing bonds and they act like everyone else is missing something. Yeah, I sure am missing that fat ass red P&L, my friend. Like, I am missing that.
Like, I'll end it on this. Even if I wanted to get into a long bond position, I'm totally happy with losing out on the first 10, 20% of a trade, with actually confirming that the Fed is pivoting, right? Like, let's go through an FOMC meeting where they don't raise rates. And then maybe you can get a little bit risky and say, you know what, now let me smell the pivot. Right?
Even then, how is the pivot a long bonds trade?
So the only way that it is it would be for, it's not for a cap gains. It would be for just a fixed income part of your portfolio, where if, let's say, you could get in on a long bond for 4.5%, and that's just a part of your portfolio, and you're not expecting rates to go to ZERP overnight. That's the only thing that I would see, because if the Fed pivots, I don't mean to interrupt you, but I really want to hammer this. If the Fed pivots and CPI is at 7%, you're still losing in real terms. You're realizing a loss on going long at 4.5% CPI above 7. Yeah. So what I suspect will probably happen, I think we will see deflation starting to kick in here soon. Last month over month with already 0%. I think over the next 3 or 4 months, you're going to start to see deflation. And I think we could end the year around maybe not 7%. I think we could maybe end the year around 5 or 6. And then you could see probably by February or March, we're down to 3.5%, 4%. So that's where you would be looking to buy, basically. Because, like, if you want to make money and you want to get on the rates, the higher rates, you need to sniff a pivot if that's what you want to do. But I think it's absolute fucking madness to try to sniff the pivot here. And they've continued to do it and got wrecked.
And the thing is, bonds are calling bullshit on the pivot. You go look at this rally over the last couple of days. I mean, this is something that's really informing my bearish bias, and it's caused me to take these bear bets over the next 3 to 6 months. Is that bonds aren't even
3 months.
moving.
Go look at the 3 months. What has it done? Nothing.
Yeah, right. But look at the 10-year. Look at the 2-year. Look at the 20-year. Look at TLT. Like, they're not even moving. Like, you're seeing, you saw a 220-point rally on the S&P in 2 days. Bonds are just, distributing or whatever, what on a chart, on like a crypto chart would be called distribution, before another leg down. And so, and then you have oil going up and you have the dollar going up. And Jerome Powell is going to come out in November and say, we're not doing anything. We're committed to fighting inflation. Unemployment is still relatively low. And everyone's going to be like, but what? The UN said to stop hiking rates. What do you mean we weren't going back to ZERP and unlimited QE immediately? Inflation came down 10 basis points to 8.3%. Come on, Jerome Powell. And it's like, they're going to be surprised when we go on and set new lows in the equity markets. And you see a degree of carnage and wealth evisceration that most people are truly not prepared for. And they're going to be like, what's going on? I bought ARK. It's down 75%. Back in 2014, I bought GoPro and it was down 85%. And I took that for a great bounce. What's going on here? Man, ARK, after being forced to sell all their Tesla and hold Roku and Zoom as their primary two holdings, why am I getting margin called on this? What's happening? And frankly, as the Bible says, a fool and his money are soon parted. And I think we've seen that, perhaps be never been a more appropriate time to use that phrase than what we've seen in this investor landscape, because you have a lot of people do it. Look, I'm not a genius, right? I'm not a millionaire. Okay. Honestly, if I keep nailing these moves, I'm going to be pretty damn close by the time the bottom comes in. But you've just seen some real head scratcher moments from some people who just, are ostensibly intelligent or informed or whatever, but it's like clearly not, because look at the shit ass fucking trades you're making. Like, it just kills me.
Kills me. And I don't think we've seen anything yet. I think we're gonna be having a few more laughs before this is over. Which I
look forward to it.
Exactly.
Where's SPX going by end of year and end of Q1?
Let's see. Where do I see it going? I think the first stop is obviously 3,400, and then the next stop is probably 3,200. If it does not hold that 3,250 area, holy shit, look out. Like, that's where the blood really starts to happen. I
don't think it's going to hold, by the way.
Well, if this is what I said earlier about my two cases, bad and then worse. The bad case is it's going to bottom out probably around 3,200 in that area. But if that doesn't hold and the worst scenario happens, like you're literally looking at like a 2,700 SPX. Like, if there's like a day where the VIX is literally at like 60 or 70, and there's
there. It's going there.
Like the March 2020 levels, it could go that high.
Yeah, it could, because when something breaks, do
you know how many shops are going to blow up on the short vol trade? That's just like a mandate to just short vol. They will get blown out, dude. Watch a short covering event on the VIX.
Yeah.
Let's see what the NASDAQ will do, dude. The market won't even fucking open the next day. It'll be insane.
Yeah, like literally in 2018, when the Fed did their last kind of like quantitative tightening, where they actually were selling assets off their balance sheet and not just letting them roll off. Even then, where the VIX got up to about 50, right? And then you got 2020 where the VIX got up to, I think, in the 80s, and then 2009 it got up to the almost 90, right? Like, so if you see a VIX, we're at VIX 30-ish or 20 or 28 now, right? Like, we have not had a capitulation. Like, you'll see, like, the capitulation, like, we need the VIX to be at least at 50, right? And if there's like a holy hell moment, the Fed really broke something moment, and the VIX goes to like 70 or 80, like, that's where you could see some real fucking damage done on these indices. I'm not making that my base case, because I need to see certain things to happen first before I call that my base case. And one of those things is the Fed just recklessly continuing to hike. So like, they do a 75 in November, 75 in December, then the new year comes around, and then January and February, they're just going balls to the wall. Then that's more likely. So we'll see how measured they are. But like, my best case scenario is pre-COVID all-time highs, which is around 3,400. And then you could see that even get a little bit lower to the 3,200s. And that's my base case. But there could be a lot worse than my base case if certain things happen. But I don't want to be a complete bear. Like, there is some things that could happen that would make me feel a little bit more bullish. If somehow miraculously Russia and Ukraine call the truth, and all those call it regulations and everything around Russia basically go away, I think that would be incredibly bullish.
And I don't think that's happening.
No,
I think
I don't.
Putin's expressly positioned to ensure that doesn't happen, because I think he wants to break the West.
Yeah, exactly. So I don't think that's happening, but that's one thing that could happen. As a good like critical thinker, I need to think of the things that, if that did happen, how I would react.
Sure.
I don't think that's happening, but that happening, and then also OPEC actually increasing production, that would be quite bullish. China,
that's probably not happening.
No, that's not happening either. China getting rid of zero COVID policy, that would be bullish for the world economy. I don't see that happening.
But what about demand for oil though? If China reopens and OPEC is still cutting.
Yeah, that's a whole other ball game. China does have backroom deals with Russia to be buying discounted oil directly from Russia.
Of course
but there is that whole other rabbit hole of what that actually looks like, because I didn't mention this, but China's real estate market is like one of the top 5 asset markets in the planet.
It's number one. It's number one.
And it's literally imploding right now. Literally imploding. The amount of wealth destruction that's happening in China right now. Like, people talk about China being this empire on the rise. I think it's an empire in shambles at the moment. Like, they're literally imploding, right? Like, they're having their 2017 Lehman moment, and there's no one there to bail them out. Like, so their zero COVID policy has nothing to do with COVID, and has everything to do with control, because they're losing the reins over there.
Yeah. I can't believe that the Chinese real estate, when I was reading about that, how they were selling properties that were still in development, and they weren't going to be completed for multiple years, and people were just scooping them up right away before they even like broke ground on them. And now they're not going to finish or even start the developments, and that money's just gone. Really, it's a horrible situation.
Yeah. 100%.
Guys, let's this was an excellent discussion, but we're pushing 2 hours right now. So I think it might be appropriate to go ahead and maybe finish off here. Listen, guys, if you've joined us for the first time, I want to thank you all for being here. Sincerely, listen, it helps us so much. Like, I'm not even sure what our viewership was today. I'm sure it was really good. Of course, this will be recorded and available for viewing on our YouTube channel at Because Bitcoin. I do want to ask you, if you would, listen, guys, if you like this conversation, if you like me, you like Max, you like Magoo, he'll be back with us in the future. Got some other huge guests coming on, people that you know very well with very visible online presences. Guys, just like and subscribe to us if you would, and just keep up with the videos that we're making. And I promise it'll all continue to get better. We do this full time. This is my full-time job. This is Max's full-time job. This is what we do. And so we really appreciate the support. If you guys would just like our videos, subscribe to our channel, help us, boost our engagement metrics. Again, it's just great for us to be able to monetize as a brand. So, just like and subscribe if you would, guys. We will be back. We do the show every day, Monday through Friday. I'm Carter. I host Market Talk, Monday to Friday, 4:15 Eastern. And so, just had to plug the show. I believe we crossed 1,000 subscribers during the show. So thank you so much to Magoo, man, for helping us cross that barrier. And then in general, Magoo, just thank you for being here, man, just and sharing your wisdom and sharing your insights. So appreciate it, man. Such an excellent discussion, touching over a litany of subjects. And so, man, we really appreciate it.
Yeah, no, it was my pleasure. And thanks for having me. I'm sure I'll be back and where we can shoot the shit again. Yeah, that'd be awesome. Well, cool. Listen, guys, like and subscribe. We're going to sign off for now. But again, hit the like button, hit the subscribe button. We really appreciate it. Appreciate your all support. And that's really it for me. And we will be back tomorrow at 4:15 with Chimp Zoo.
Who I know Magoo has some thoughts on, but an entertaining personality nonetheless. And so we're going to talk Bitcoin, talk crypto, talk markets, and be sure to come back tomorrow. So thanks, everybody, and have a good evening.